Okay, so when the news flashes red, headlines are screaming recession, and the market starts, tumbling.
Hmm.
What do? Do you panic? Maybe hide your cash under the mattress.
Or do you see something else?
Or do you quietly start seeing maybe quantified opportunity? That's really the split, isn't it? The difference between a long-term investor and, well, an active trader.
It's a huge distinction.
Yeah.
And today, yeah, we're diving deep into the mindset of that second person, the source material we're using. It's built on like over 10,000 hours of professional trading experience.
Wow.
Yeah, and it focuses specifically on structuring trades that can actually work when most people are running for the exits.
Which is fascinating because most people see bear markets, recessions, they see financial devastation. We're basically taught to fear them.
Right.
But the source material explicitly says these downturns can be very exciting for a trader. Now, I have to admit, that word exciting, it gives me pause. Isn't high volatility just, well, another way of saying high risk?
It is high risk, yes, but it's also, maybe high clarity. Does that make sense?
High clarity. Explain that.
Well, volatility is the thing that makes trading potentially lucrative. Think about it. A slow, grinding bull market makes short-term gains really, really hard to find.
Right. Tiny movements.
Exactly. But the rapid kind of extreme movements you get in a bear market, they create these predictable patterns, these clearer short-term chances. They're honestly far easier to profit from, if you have structure, of course.
Okay, structure. That feels like the key word here. So our mission today is really to pull out that foundational structure, the mental game you need, and the technical language you absolutely have to speak.
You have to speak the language.
Yeah, to make that shift from feeling fear to actually spotting a market opportunity. Let's unpack this. Maybe start with the mindset, the psychological part.
Yeah, let's jump right into the trader's mindset. The source gives these really specific success tips, and the first thing that jumps out is successful trading. It's about skill, structure, execution. It's not hope. It's not gut feeling.
Okay, skill and structure, which brings us right back to that first rule you mentioned, embracing the volatility.
Yes.
Because if the market's jumping, say, 2% up one day, then 3% down the next, that feels like chaos. How does a trader possibly harness that?
See, that chaos, it's really just liquidity and movement. In a stable market, price swings are small, right? Finding a meaningful short-term move is tough.
Yeah.
But in a bear market, the consistent selling pressure, that delivers high volatility. And that means fast, extreme, defined price movements. These wild swings, sometimes 1%, 2%, even 3% on the index in a day. That's the fuel.
Okay.
If you know the patterns to look for, the sheer speed and size of these moves make the short-term trades. And the source uses these words, extremely easy and lucrative.
Huh. That really reframes it. It's not chaos, it's just speed. Acceleration.
Precisely.
Which leads us, I guess, straight to rule number 2 then. The 2 essential skills. You need to master riding momentum and you need to master nailing pullbacks.
That's exactly where the money's made. The source is super clear on this. The wrong way to trade is trying to perfectly time the exact moment a trend dies and reverses.
Like trying to catch the absolute bottom or top.
Yeah, exactly. That approach is high stress, and honestly, it generates pretty insignificant gains compared to just following the strong path that's already there.
Okay, so if a stock is dropping hard, that's the momentum. But how do you jump on a train that's moving that fast? That's where the pullback comes in.
Exactly. A pullback isn't the market reversing course. It's more like the market catching its breath.
A pause.
A pause, yeah.
Yeah.
The source calls them short stoppages or small reversals that happen, temporarily within a bigger established trend. They're short-lived. They're expected, actually. Healthy, even.
Healthy?
Yeah, the market kind of needs them to keep going in its main direction. And for a trader, they are your chance, your window to get into that strong trend at a better price, a more optimal entry point.
So essentially, you wait for the momentum to just pause for a second, grab a seat, and then ride the next wave down.
You got it. And the source notes that pretty much all the successful setups they teach, they're just different ways to spot and, as you said, nail the pullbacks.
Okay, that's the skill set. Ride momentum, nail pullbacks.
That's the operational part. But look, neither of those skills matter much without the third mental rule. And this one is arguably the most critical for just staying in the game long term. Always have an exit plan.
Ah, yes. This is the big one, isn't it? The emotional hurdle. The difference between maybe a pro and a casual trader is actually executing that plan when things go south instead of just hoping.
Oh, absolutely. A professional trader plans for the downside before they even click the button to enter the trade. That means defining a mandatory stop loss.
The point where you just get out.
The price point where you exit, period. For a planned, acceptable loss. You do it to stop that loss from snowballing into something, well, catastrophic. You have to treat that stop loss like gospel, no negotiating with it.
And the math behind this, the way you quantify the risk, that's the risk to reward ratio, right? This is where the profitability really shifts.
Precisely. The R ratio basically dictates how much you're willing to risk compared to how much you realistically plan to gain on that specific trade. The source hammers this home. A really good setup should have an RR ratio above 1 to 2, preferably even higher, like 1 to 3 or more.
Okay, let's break down that 1 to 3 ratio power, because this math, this is where it starts to really work for you, even if you're not right all the time.
Totally. If your RR is 1 to 3, it means for every, say, $1 you're risking if you hit your stop loss, you're aiming to make $3 if the trade works out.
That's huge leverage.
It's the professional trader's edge. It means you can actually be wrong significantly more often than you're right. Think about it. With a 1 to 3 ratio, you could be wrong 2 out of 3 times, like 66% of the time.
And still break even.
And still break even, roughly. So if you just maintain a win rate of, say, 40% on trades with a 1 to 3 RR, you're highly profitable over time. The RR is like your firewall against that emotional pull to let losers run and cut winners short.
That really is the ultimate secret weapon of discipline, isn't it?
It is.
But, okay, to execute these rules, to find that pullback that gives you that nice 1 to 3 setup, you have to be able to read the map, right? We need to start speaking the language of the charts.
Mandatory. Absolutely mandatory. If you can't see the context on the chart, the best RR ratio in the world won't help you much. So yeah, let's look at the 4 sort of fundamental concepts that structure the market according to the source.
Okay, let's start with the most basic one, the trend.
Simple enough. A trend is just the continuous movement of the price in one direction. And the direction depends on whether the peaks and troughs, highs and lows, are consistently moving up or down.
So, a bull trend. That's when you're constantly making new high peaks. Each peak is higher than the last one, like a staircase going up.
Exactly. And conversely, a bear trend is when you're constantly making new low troughs, pushing the price lower and lower, like a staircase heading down. And the key rule of thumb here, from the material, the more clear and consistent those peaks or troughs are, the stronger, the more reliable that trend is considered.
Makes sense. But what happens when the market stops climbing or falling? When it just sort of pauses? That's consolidation, right? This is where things get messy.
It can get messy, yeah. Consolidation is a really crucial phase. It's like a battleground. The price is moving up and down, but it's not really committing to a clear direction. Buyers and sellers are kind of duking it out for control.
And this looks like sideways movement on the chart.
Often, yeah. You see it graphically in shapes, like a wedge, maybe a triangle, or just a horizontal channel, like price is stuck in a box for a while.
Okay, why do the shapes matter? If it's just moving sideways, why do we care if it's a triangle or a channel?
Because the shape tells you something about the pressure that's building up. These consolidation patterns, they're basically like market springs getting coiled tighter and tighter. A triangle, for example, usually shows the range of price swings getting smaller and smaller. Supply and demand are compressing. That typically signals that a big, maybe even violent move is coming once it breaks out of that compression. Recognizing the shape tells you, okay, get ready, something's about to happen.
Gotcha. Okay, that leads us to a really critical distinction, one that sounds like it separates profit from loss pretty often. Reversal versus pullback. We touched on pullback, the brief pause. So what's a reversal, and why do people get fooled?
Right. A reversal is different. It's an immediate, sharp change of direction that likely marks the end of the previous trend, at least for a significant period. It kicks off a new trend in the opposite direction. It's usually long-lasting.
And people get fooled how?
They mistake a really sharp, maybe scary-looking pullback for a full-on reversal. They think, oh, the market's finally turned around for good. But often, it's just taking a deeper breath before, whoosh, continuing the main trend.
And the source brings in some fascinating bigger picture context here. It says, basically, over the long haul, like 5-10 years, the stock market generally trends up, right? Unless the fundamentals are just completely broken.
That's the historical tendency, yes.
So statistically, that means most sharp downturns we see. Maybe they should be viewed more often as just huge pullbacks within that grander overall bullish journey, rather than true long-term reversals starting.
That's a really important perspective. It definitely informs your bias. The market tends to reverse less often than it pulls back, which brings us to what happens after that consolidation or pullback ends. The market starts its new path with a breakout or a breakdown.
Okay, these sound like the action signals, the events that really mark the start of the next big move.
They are. They happen when the price finally pushes through those significant levels we talked about, like the top or bottom of that consolidation channel or triangle. A breakout is a push upwards. A breakdown is downwards. These are often the prime entry points for riding that new momentum.
But there's always a but, isn't there? The source warns about the danger lurking here, the false breakout, calls it the bane of many traders' existence. What does that look like? Why is it so frustrating?
The false breakout. It's painful. It happens when the price tries to break through that key level. It looks like it's going, so traders jump in thinking, here we go, new trend.
Right, FOMO kicks in.
Exactly.
Yeah.
But then, almost immediately, the price fails. It reverses sharply and dives right back inside the old range, the old boundary.
Ouch.
Yeah, it traps all those traders who jumped the gun, hits their stop losses, takes their money, and then often the price might even take off in the opposite direction eventually. Recognizing that potential trap is just vital for survival.
Okay, so how do we avoid that trap? How do we get some confirmation that the move is, like, real this time? Is there a clue? A subtle sign the market's truly made up its mind?
Yes, there often is. And this is where we get a really cool bonus insight from the source, focusing on reading key candles. Specific candlestick patterns. They're like little windows into the market psychology at those critical moments.
Right, those little bars on the chart. What are we looking for specifically?
We're looking for candles with really small bodies, meaning the open price and the close price for that period were very close together, but with long lines, those wicks sticking out from both the top and the bottom.
Small body, long wicks, top and bottom. What does that tell us?
That specific look. It screams indecision. It signifies a really fierce but ultimately equal fight between the buyers and the sellers during that period.
How so?
Well, the long wicks mean the price moved dramatically higher and dramatically lower within that single candle's time frame. But it ended up closing almost exactly where it started. Total stalemate.
Ah, I see. Extreme indecision.
Exactly. And that indecision is critical because you tend to see these candles appearing during reversals, during pullbacks, and right at those consolidation boundaries we talked about. Basically, all the points where a shift, and therefore a potentially high probability trade entry, is about to happen. It gives the disciplined trader that extra bit of confirmation before they put capital at risk.
Wow. Okay. This has been a pretty complete overhaul of how to even think about market downturns. Let's try and summarize maybe the 3 core messages we pulled out from this deep dive into the foundations of bear market trading.
Okay, 3 things. First,
Yes.
try to shed the fear. A bear market isn't just a threat. It's actually a quantified, high-speed opportunity. It's fueled by that big volatility, which can provide clearer, short-term patterns if you know what to look for.
Right. Opportunity, not just fear. Second.
Second, emotion is your enemy. You absolutely positively must have a risk-managed plan before you enter any trade. That means a non-negotiable stop loss. And aiming for that favorable risk-to-reward ratio, ideally 1 to 3 or better. Plan the trade, trade the plan.
Plan the trade, trade the plan. Love it. Okay, and third.
And finally, trading is fundamentally about recognition. You have to master these core concepts we discussed, understanding trend structure, spotting consolidation patterns, knowing the crucial difference between a pullback and a true reversal. That knowledge is essential for actually seeing those high probability opportunities when they show up on the chart in real time.
Okay, we've built the framework. We understand the mindset, the rules, the basic language. So knowing this now, I have to ask you, the listener, does the thought of a market downturn still fill you with dread? Or do you maybe, just maybe, start to view it as a quantifiable, tradable opportunity that's waiting to be exploited?
A big question.
It is. And in our next deep dive, we're going to move beyond the what and the why and get straight into the how. We're leaving the mindset and the jargon behind, mostly, and moving to practical application.
That's right. Remember those 21 proven recession-resistant setups mentioned in the source. We're going to dive straight into the charts next time and start explaining the first few specific strategies, things like the gap fill or the engulfing candle momentum game. We'll show you exactly how this foundational knowledge gets put to work to actually capture those 1 to 3 type opportunities. You won't want to miss it.